what's maybe the single biggest lesson that you've learned about building sustainable wealth through real estate?
Making sure you do due diligence on the people you're going to partner with. The most frustrating, financially damaging, time sucks have been with working with the wrong partners and then having to spend years undoing to the best of your ability. I would say if I was starting over, I would do a much better job of that and being more, not necessarily cautious to not doing it, but aware so that I did it better.
Welcome to the On the Rise podcast, where we talk about time freedom, passive investing through real estate, finance, and mindset. Let's dive in. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice. I am not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. Welcome On the Rise podcast guest. Thank you again for jumping into another episode. Really appreciate you being here. I have another amazing guest, as I do always. I've got Joel Kraut. Joel, welcome to the show.
Jeremy, thanks for having us on. We're excited to be here. It's cool to connect with you. We've seen your company and some of the portfolio that you guys hold is incredible. And as we were talking off camera, just being from a part of the country that we don't interact with that often up in Minnesota, we're often in Michigan and Chicago, Illinois, and places that head south from there. Today's world, the Rust Belt is on fire, as you know. No longer the Rust Belt's become sexy again. I've waited a long time in my career for that to happen, but it has. Ohio's on fire, and even Kentucky and West Virginia and the Illinois markets, those are all really hot. We get a couple of requests in Minnesota now and then, and I know the real estate is really good there as well. So it's a great opportunity just to be on with you and collaborate. It's cool.
Yeah, no, I appreciate you being on here as well. And what we call it, us, current Midwesterners, we call it the boring Midwest. But I like the Rust Belt being on fire too. So that's a good way to put it. But Joel, truth be told, the reason why I wanted to have you on the show today is really for you to talk a little bit more about kind of your 20 years of experience, really structuring complex real estate loans. And I also know that you've got a particular, interest in kind of what we'd call, I guess, a niche, property, type portfolio, things like hotels and gas stations and, car washes, self-storage, which are completely unrelated to, what our typical buy box, being in that multifamily space, is or looks like. So we'd love for you to maybe just let us know a little bit more about, yourself, your background, your story, what you're focused on today, et cetera.
I started in 1996. I bought my first investment property basically unknowingly. The realtor who had sold me my primary residence when I moved from New York to New Jersey probably had a deal that fell apart on a small condo. She knew what I did for a living. I was trading on Wall Street at the time, and I was starting to have some success. She saw the mortgage approval for the house, and she came to me and asked me if I'd be interested to purchase. I didn't really know what to do. I'd read some books on well-to-do families, and the one constant theme in those families, they all owned real estate. And I figured since, I'm never going to be an entertainer and I couldn't dunk, I figured if you want to be like Mike, you got to do what the rich people are doing. So I told her yes. I think we bought the property for $72,000 or $74,000, rounded off. We did really difficult things in renovation, like changing a mailbox, the front light. I think we painted part of the bathroom, put a medicine cabinet in. And I think by the time I was done, I spent about $7,000 or slightly over that in renovations, which shamefully 29 years later, I could still do for half the price and still get great quality work, right? I could still have the guys who would come to my primary residence do it, but I didn't know anything. There weren't a lot of meetup groups, or I didn't know anything about them. The only thing I could ever remember late night was the older gentleman, Carlton Sheets, from like midnight to 4 a.m. That was my exposure to, quote, investment real estate. And Mindy, who was the realtor, she helped me. She really took over the projects for us. And about a year later, a mortgage rep came to me, who I still to this day think is one of the smartest mortgage reps I've ever met. No disrespect to anybody listening or out there. But her name was Maria, and she figured out that if you owned more than 2 or 3 mortgages in your name, you were probably an investor. So instead of going hunting after Jeremy and Joel and our friends, we were going to individually buy a primary 5 or 7 years on average. She looked for everybody who had multiple mortgages that had 10 months of history on them. And then she would approach you to ask you if you were interested in refinancing the mortgage. Now, back then in the 90s, you needed to be at 12 months and a day before a bank would give you a cash out refi and really adjust to the market value. I knew none of this. She explained all of it to me. Absolutely thought it was criminal. I thought that sounds way too easy being a Wall Street options trader. They cannot be letting smart people around America do this. This is way too easy. They'll be killing it. So I called my friend Mindy. I begged her not to laugh at me as I asked the questions. Of course, she started laughing. And we went ahead and did it. I got my money back, my original 20% down payment, plus about 18-ish thousand out of the property. I still owned it. It cash flowed. And from there, I just thought that was crazy. We went on, did 11, so 22 mortgages with Maria over the next 2 years, and we just kept rolling from there. So I learned how to use other people's money. I was working on Wall Street. Money was flowing pretty good before the dot com boom and into the dot com boom of 21, 22, that part of the cycle. And a lot of friends wanted to or were willing to lend money out at a very, what I thought was a modest interest rate, 10, 12%. And I could basically use their money for down payments. They were the gap funder, as they're called today. Back then, they just thought they were trusting a friend. And we built a large portfolio of about 145 properties in a 30-month span. So unlike you and your team, infinitely smarter, where you're having third party property management, professional third party property management, where you guys are spending a lot of time and effort and due diligence on vetting them. We were insane enough to do it ourselves, which I would highly recommend against. Based on, you end up with that kind of haircut and a couple of ulcers along the way. So it was an amazing experience, though. And in '08, I learned another due diligence gem, which I wish I would have learned earlier, but I had tremendous exposure to Walmart and an upstate New York large supermarket chain. And I didn't realize how much exposure I had to them. About half of my tenancy actually worked third shift for both of those two companies. And during the big depression, became a depression for me because, got hammered. But during that big recession, they laid off the whole third shift. And I went from having 1,000 paying tenants to 500 basically overnight. So again, not really doing proper due diligence and enough of it to understand what I was getting myself into. And now learning that much better over the years and that experience, putting that to work now as we invest in different markets, being much more aware. It's crucial. I know on your website you talk about really betting on the jockey when you're doing these syndications, right? Many people came to market. They had no experience. You guys have nice breadth of experience, nice portfolio, a few different market areas. You have some people who have exited. You've put money in yourselves. A lot of things a lot of people haven't done. And it always amazes me. So many people want to be investors, and one of their friends told them it was a good thing to do, and that's their due diligence. But yet, if they're going to go buy a car, Jeremy, think about it, right? They get the Kelly Blue Book. They know the Carfax. They know what the MSRP is. And they'll go spend the whole day fighting for $9 a month. But they thought giving you $400,000 on a whim with a quick check was a smart idea. I never understood that. And to this day, whenever I get a chance to talk with you, people are laughing about that, not at the people, but amazed that they would do it that way. And we all actually take a step forward and ask them to do more research, right? You've been in the markets a long time now. You have a lot of track record. You want to spend time educating the people and helping them be successful. It's not just about you and I being successful, it's about them, right? Because if we do it that way, we can always be successful. We can raise money, we can go buy more properties. People know you can close, they're going to come to you with opportunities. But we need to invest in our people so that we have that available to us. And I think that's a huge disconnect in the whole syndication market now.
Yeah, no, I couldn't agree with you more, and I appreciate you kind of sharing your background and your backstory, and it kind of resonates with me, a little bit as well in terms of how I first got into the space. Was really, I used the strategy of hold my breath, plug my nose, right, and kind of figured my way out, and navigated through, the complexities of this space, and certainly, chalked up a lot of wins, but also chalked up some failures, and kind of learn through those experiences. And I appreciate, talking to an investor such as yourself, where you've lived through, multiple market cycles in the past. And so that, gives you a lot of, probably a lot of confidence when it comes to, certain times to invest versus maybe, other times where it doesn't make sense to invest, and obviously pivot during other times into different asset classes and things of that nature. But, you're exactly right. I mean, financial literacy is really a gap in America today. It's not really largely being taught, in our high schools and even in our, colleges and universities. And quite truthfully, most investors, make decisions based upon what they see in the headline news or what their friend Brad told them, right? And so I really appreciate, your perspective, on doing proper due diligence and really, spending more time on the front end, making sure you fully understand, where exactly your hard-earned capital is going to be placed, and how exactly does that operator, that sponsor, intend to execute, on that business plan, and what risks, are there, over the course of that investment, hold period. And I just frankly don't think that all investors really truly understand, the risk premium that they're paying when they choose to deploy their capital with an inexperienced sponsor, or an investment group that really has, doesn't really fully understand exactly what they're doing, and they haven't lived through, multiple economic cycles in the past. Does that make sense?
It absolutely does. I don't believe you have to go through every pain point to be successful. But if you're out there on the road, you're raising capital, you're investing and deploying, and you haven't been through any, or part of your team too, by the way, there are going to be different ages, different levels of experience, and different aspects of your team. But having nobody who's ever, run into a hiccup. I mean, the whole premise that we start from is we're trying to find problems attached to real estate and solve them. And that's where the opportunity comes from. So if you've never solved a problem in your life, even outside of real estate, how are you going to know to recognize one, find one, and then go figure out a solution that you could present that's a winning solution for both sides? You know, to your point, most people around the country have horrible perspective. I was trading in 1987 in the OEX 100 pit, and the market in October fell 25% in one day. People on the news now think the sky's falling when the market's down 1.47% because the media heads have made it sound horrific. It's unbearable. You can't stomach this. You should never do this. This person's an idiot. That person's out of their mind. The whole world's on fire, right? 25% versus 1.47. Look, I'm not saying we need that 25% correction. I don't. But building portfolios that are made to last, that make sense, that's what you should be doing. I mean, you're working 40 hours a week, 60 hours a week, and you're going to give somebody money in 5 minutes. Does that really make sense? Think of that ratio. Like, it doesn't even make sense. So, we want to help people slow down a little, think and understand how to ask questions. To your point, you know, I graduated from Penn State University. I was a great multiple choice test taker. The problem is, since I graduated in '84, I've never gotten another multiple choice test. It's unbelievable. I think I could still score a 90, but no one will give me one. So we need to learn how to think. And to your point again, we're really not doing a great job of that in a lot of the school system. We're doing great at teaching people how to get ready for the next test, but we're not teaching them how to approach the exit. The exit being, we're going to graduate, and now what are we doing, and what are we really interested? What makes us feel something? What do I want to go set 10, 15, 20 years of my life to? The concepts of passive versus working all day for it, right? Everybody, regardless of where you're from, what you look like, shape, color, size, doesn't matter. I think at the end, we're all after freedom, right? We may have different levels or different definitions, but at some focal point, that's what we're all after. And they're not teaching us that in school at all.
Yeah, yeah, amen. And freedom can take on a lot of different meanings for different, people. But I think the freedom that you're predominantly referring to there is this concept of time freedom, right? Which is something that none of us can create more of, but we can certainly, look to seek after in terms of the time that we spend, with those that we love the most, and on the types of activities that we enjoy the most as well. So when Joel, when you look at a deal today, what are the first couple of things that tell you whether it's a fundable deal or it's dead on arrival?
Well, dead on arrival is poor structure of the buildings and structures themselves, right? I mean, I do look at that. I tell people, young investors, when they're out on the road all the time, you take a quick look at the roofs, look at the foundations and basements, and if they're really in bad shape, just go to the next one. Now, if you're a more sophisticated, experienced investor and you can really get your arms around that and you have the right teams and engineers to help you with that, that's different. But when you're starting out, those are tough overcomes. It's easy to replace windows. Everyone can paint. LVP flooring, there's a million people that can install it. You can buy it everywhere. But, foundations are a bit of a talent. It's not quite as easy for everybody as they think. And, there's a big push right now on new construction around the country. On the larger scale, there's been tremendous amount of permits issued the last 36 months for larger multifamily, A-class multi in a lot of different areas. There's been a lot of single family development. I know the government always tells you we need more, more, more. They attach the word affordable to it at the same time. So I'm not sure how we arrive at that. I don't have that solution, but I know new construction has been on fire. I've literally stood on a job site, watched the foundation go in, started to help backfill, and had a foundation wall fall on me. So that's a different level of experience and understanding of what really happens out there. And you want to help people with that. You want them to be successful. They're going to have our money in their hands. Selfishly, we need them to be successful. So we have to help them with some of that experience and knowledge so that they can avoid obvious mistakes. And again, how old is the house? What are we looking at? I try to stay away from 100-year-old houses now. I'm not that excited about that product anymore. We're trying to stay like, let's say 1960s, 70s and newer. It's a whole different building structure than was. I mean, some of those old brick and mortar type foundations are really solid, but some are cracked. And once they're cracked, they're hard to work with. So we're looking for more modern technology. Technology keeps evolving probably every 36 months, we'd say. So to have something that's 30 cycles old or more is pretty difficult to work with. So we're looking for things like that and helping people.
I'm Zach Captainstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investor. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
Sounds to me like you're not interested in properties that have chillers, boilers, copper plumbing, asbestos, those types of things, which, truth be told, we're not either. I do know that there's a couple of particular asset classes, that you are well known for, and that is gas stations and car wash financing. So, what do you feel like makes these asset classes, so maybe misunderstood, yet they're potentially very lucrative?
I think from the investor side today, one of the hot buttons out there is self storage. There's been a lot of people who have raised a lot of money for self storage. Look, self storage is awesome. Your clientele goes home at 7 p.m. at night. No one's having a toilet back up at 11:30 at night. Usually, with today's technology, there's minimal break in or there's different alarm systems set up. So that's become a significant investment property. But I've done a lot of work in the specialty use type properties. I know it's really popular on television to watch a gas station blow up, but in real life, it just doesn't happen. It's just not real. The technology that's been changed now, they use, if you're driving down the road and you see one of those tanks, a 15,000 gallon tank above ground, and you see how large it is, it's like, wow, it's just hard to believe. But those are double wall fiberglass now. And if you search the internet, there's not one that's spilled. So you're seeing huge change in technology, upgrades in undergrounds. It's one of the most heavily self regulated industries there are besides the drug industry. So safety there, you're seeing large corporations invest huge money the Wawas of the world, the Sheets of the world, Quick Checks, people with large, large chains of hundreds and hundreds of locations. And Cumberland Farms is another one people might be familiar with. And you're seeing people make tons of money over the years. And financing, yes, it's a little tricky, but it's definitely there to be had. And a lot of banks will fund them. Banks right now are really looking for owner occupied properties on the commercial side. And I know these aren't their favorite sons, but remember, all these were open during COVID. They made money during COVID. And it's harder and harder for banks to fight back about that now because they saw it during their cycle time. So it's gotten a little easier in that respect, actually.
Yeah, no, I couldn't agree with you more in that regard. And I'd, like to maybe kind of drill down a little bit more on this kind of topic of environmental issues. I know that they can really, make or break a deal. So what should your, non-savvy, non-sophisticated investors know before buying or investing into a property that may have potential contamination or regulatory risks?
Well, I think as a starting point, everybody wants to save money. I get that concept. But as investors, as investing into a syndication, you still want to understand what's there, right? So asking the syndicating group, do we have environmental reports like a phase one report? If something was found, is there a phase two report? Has somebody done reviews, what's commonly referred to in most parts of the country as an OPA review, an Open Public Records Act review? So they're going to the Departmental of Environmental Protection for the respective state and actually searching all the files they have on that property. And environmental engineers can help you as an investor, a direct investor, or also through syndication models. The people who are the GP group will be doing that type of work. And you might want to read it. You may take their word, but you want to make sure it was done, right? Because in most states in the country, if there's a problem in the ground and you go to contract and you buy and close on it, you will be taking over that problem. There are great indemnifications from big oil, the largest 5 or 6 oil companies around. Those are great. Banks love those. But truthfully, if Joel Kraut is your indemnifying party and Joel has 50 other investments, you don't know if the indemnification is any good. So you want to pay attention to this and understand what you're getting into. In the old days, car washes really did use chemicals. Not so much anymore. The recharge systems in the ground now basically clean the water and refilter it. Gas station technologies improved dramatically. But we joked early on about the Rust Belt, but if you think about it, a lot of America at one point was industrial. So there is a lot and was a lot of different things in the ground, and you want to pay attention to that because it can greatly impact your results.
Yeah, thank you for sharing that. And I know, Joel, I've heard you say once before that the McDonald's franchise is one of the most important companies for real estate investors. Can you explain why that is and why that connection exists?
I like to always talk about it when I'm speaking publicly and kind of make it fun for people, but I'm a really simple guy. I like to find really easy, obvious ways to do some due diligence. And as I travel around America and I'm looking for places that could be solid rental areas, not Class A. All right, Class A is different, but B minus, C, that kind of range property, I want to know that there's multiple fast food places. There's a Walmart, right? I don't need 6 Starbucks. 6 Starbucks is too expensive for my area. But McDonald's, pizzerias, nail salons, Chinese food takeout, these are solid in the areas where you can do a lot of work on the rental side. I'm looking as an investor, I'm flying into a city, and I want to be able to put together a portfolio there, not just one off. It's too expensive to one off, right? As you start to cluster, you get economies of scale, and that's what we're looking for, right? So if I'm flying into pick a city, Cleveland, because that's really popular now, and I'm drawing a 1 hour circle around it, what does it look like? Where should I go within? What makes the most sense? And I'll be out with a realtor and I'll be counting them off like 1 McDonald's, 2 McDonald's, three. She's like, wow, you're really hungry and you love that fast food stuff. And I'm thinking to myself, well, they spend $1 billion a year on market demographic research. So why wouldn't I follow them, right? I might not eat that fast food unless I'm really stuck late at night. But all kidding aside, I want to see where they think it's important to open new stores, maintain their stores, upgrade their stores. is there also some road construction going on concurrently with that? That's like the perfect blend of where I'm going to find outstanding rental opportunity.
Yeah, no, I appreciate that perspective, and I think people have once told me that McDonald's is the largest real estate owner in the world, but I actually think it's the Catholic Church, and maybe McDonald's is second to that. Somebody can fact check me on that and reach out to me later. But Joel, looking back along the decades of experience you've had, as an investor, it's centered around kind of the real estate space. What's maybe the single biggest lesson that you've learned about building sustainable wealth through real estate?
If you're going to do it on your own, that's one thing. But if you're going to partner with people, making sure you do due diligence on the people you're going to partner with. The most frustrating, financially damaging, time sucks have been with working with the wrong partners. People who give up quick, people who won't fulfill their obligations to whatever it says, and then having to spend years undoing to the best of your ability. So I would say if I was starting over, I would do a much better job of that and being more, not necessarily cautious to not doing it, but aware so that I did it better. That's really important. We all sound great online. We all can write good books. We can build courses. We can do this, that. But who has really done this and really can help people, help themselves as well, follow through? I don't want to take anything away from somebody who's been investing for only 36 months, but it's not the same level and breadth of experience and being able to stand there when things go wrong, right? You have a construction loan out with a bank and the bank goes out of business and your co-lenders and LPs want to know what the hell's going on. You better have a plan. The plan might be more expensive than you set out, but you need a plan. You can't let that just sit there with a crane in the air, right? That gets exceptionally expensive for you. And also, you think about the damage to the years of credibility that you've built, how quick that can unravel on you. You need to have all those ABC plan type things already thought out. And you need to also pick people who have the stomach, the intelligence, the wherewithal, either have capital or understand how to get access to capital. And that needs to all come together to be most successful. So, for me, that would be one thing that I would key back on.
Yeah, no, I appreciate that. And that perspective, I think, applies to really, anybody in any industry. And that's the power of partnerships. And, we always hear the cliche saying, your network, is your net worth kind of a thing. But, truly aligning yourselves with the right, the right people that, align with you, whether that be, from a trust-based relationship or credibility, or, transparency and authenticity. All those things are incredibly important, when choosing the right partner. So appreciate that. Joel, what might be maybe one or two different ways that our listening audience can connect with you to learn more about what you're up to?
I mean, some of the easiest ways are to find us on Instagram. We're at Burr_loans, or just go to our website at burr.com, B with four R's.com. We got a pretty cool website. People like it in general, and that's an easy way to connect. We're out on the road a couple times a month around the country, speaking in front of groups and meeting with people. To your point, your network is your net worth. I know that's very Facebook-ish, right? But it is real. I mean, you've had the opportunity to meet some amazing people. A couple of your past guests I know, and that has been really a great opportunity for me. I mean, some of the people I've met on the road who have been at it for anywhere from 5 to 40 years and really at it. I mean, they've done thousands of deals. Some failed, but they'll readily talk about them and show you what they learned from them, how they applied that new knowledge, and how they became successful out of that failure. I think one of the, I know this sounds cliche too, but I really feel like most people don't win because they quit or they're afraid to fail, so they don't do anything, and they just stay in status quo. Which, look, doesn't make you a bad person. It's just not what I do. I like to joke you don't get this pretty without taking a few punches, but truth is, anyone who tells you they only won is either hasn't done enough deals or they're actually lying because it's just not possible. You do 1,000 transactions, you cannot win 1,000 in a row. It's just not real. The math tells you it's no.
Yeah, that's right. Yeah, that's right. And that's again true in all walks of life, right? It's the action takers that dominate in just about every aspect of life. So, it's one part, getting educated and learning. It's a second part, but actually taking that consistent, daily action, towards whatever that goal, happens to be. So I really appreciate your, life lessons there, Joel. Again, also really appreciate, you being on the show and the tremendous value that you brought us today.
Look, I appreciate the opportunity to be here with you. You, your team, your company, what you guys have built over the last decade, it's real, it's strong, it's vibrant. It's done amazing things for people and helping them build their financial futures. To be able to associate with people like yourself and just be in that network, that's how I learned too. And the goal is to always be learning. So, for me, that ABC is not just always be closing, but always be learning. And I think that's crucial to anyone's success. You can buy cash flowing businesses, you can buy cash flowing real estate, you can do some of real estate, some of the stock market, you can do whatever you want. But at the end, if you rest on what happened last year, you will be looking for the exit doors soon. So we have to stay fresh. We have to keep up with different people and see what they're doing, the markets, etc. And I think it's a great time to be in real estate. It's an interesting time. The markets have changed a little bit again, and definitely separated across the country. Not all markets are equal anymore, and just going straight up to the matter of what degree your market's going up versus mine. Now some are truly going down, and some are going sideways. And in the Northeast here, we're still blessed that some of the areas are still, they just keep appreciating. I don't even know how sometimes, but they just seem to. It's crazy, but true. So it's an interesting time. And again, plugging in with people like yourself and building these types of friendships and just networks is awesome.
Yeah. Well, I appreciate that, Joel. And listeners, let that be your charge for the day. Appreciate you being here. And we look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the On the Rise podcast. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decisions, please consult with a professional. This show is copyrighted by the On the Rise podcast. Written permissions must be granted before syndication or rebroadcasting.